And yeah, just got back from Hawaii, taking a little vacation. Good time to get away from the markets, as it turns out. Called the top of this recent pullback, and then yeah, good time to take some time off. Well, the market's just kind of in a funk again. So I'm going to be going through this and been putting some final touches on things, and yeah, we'll take some questions at the end, and then let's dive in. And then this will be recorded for anybody else who wants to catch it a little bit later. All right, so thanks for everybody for tuning in. As I said, the title basically bullish or bearish. I figured that made sense for what has become the most debated market condition that I've ever heard of. There are people on both sides of the debate, bullish or bearish, and pretty adamant about it. So what I'm going to show you is kind of the things that I've come across. It's going to paint a picture that I see, but that doesn't mean I have to be right, and it doesn't mean that things can't change. So we just kind of need to be sure we get that. It's what I see now with current conditions and current information. All right, and then just remember that this is educational purposes only. We're here to have fun and tune up with the market and check in. So none of this is actual investment advice. All right, and another big news announcement, we've updated the Moxie indicator. The actual math itself, nothing's changed, so just don't worry about that. But what we do have is the Moxie power dots. This is what we've been calling it. You can see it here on the left. It's basically the yellow dots. It's basically when the Moxie indicators get really tight together, there's going to be some action. It's kind of like the calm before the storm. And we've been having some pretty good success with it, and so that's part of the new updates. If you guys have the Moxie indicator already, these updates are free for you. If you don't have the Moxie indicator, we're running some specials at the end, so be sure to check that out. We can also scan for those Moxie power dots if you guys are interested in that. And then another thing, we've added price triggers, Moxie price triggers on the 5-minute and the 2-minute. You can turn those on and off. Same thing with the power dots. You can turn them on and off, and you can configure them. So giving you guys lots of options if you want. The other thing is we have streamlined the Moxie indicator install. Instead of like 7 indicators that we had to do it the old school way, we've now automated it. We have 1 indicator that will auto-populate to the correct time frames, and that would just make it a lot easier for you guys and anybody new who wants to get into this much easier. So easier to set up and to use, and it's available on Thinkorswim, TradingView, and StockCharts.com. Still rolling it out on StockCharts.com, but everything else is looking pretty good, so just bear with us. All right, so yeah, Gil, yes, right. Am I bullish or bearish? Yes, right? I love that. So we're going to be getting in here. This is some of the stuff that I'm seeing out there as far as, say, the bear camp. There is a lot of all right, I'll turn that off. Let's see. Let me know if that helps at all for the choppiness. And all right, so as far as this goes, this is a very interesting chart that I came across. As you guys can see the source, but looking at this, that there's a little bounce, and then it's like okay, we're getting back to normal. Everything's okay. Give us a little bit of hope, and then it just comes back down and just gets hit pretty hard. Now, I don't know if that's going to happen. None of us know. That's what we're trying to figure out. This is one possibility, and this is kind of what the bear's case are. Think about inflation, Fed tightening, all that kind of stuff. The contraction of the economy, recession, all that kind of stuff. This is the concern that's going to happen, and so we need to figure out if that is in fact the truth. Like where we're going to go with this. And yes, anything is possible. Here is the SPX from 2008. This is another kind of idea of what might be happening out there. People are worried about just falling off a cliff and having a repeat of 2008 as we continue headlong into a very, very strong tightening cycle as far as the Fed and the tightest it's ever been in history and all that kind of stuff. I'm sure you guys have heard about it, and we're worried about this. Now, one difference with the 2008 was that this all happened so fast that we kind of got the bear market over and done with, and then it was off to recovering. This was a fairly short bear market compared to I'll get to that in a second, 2000, and that was 3 years. So one of the quotes from Warren Buffett, "Be fearful when others are greedy, and greedy when others are fearful." I'm wondering if that applies right now. It's just something to kind of think about. I'm not saying, okay, it's smart to just dive in right now. I'm not necessarily seeing all those kind of signals. But it is something to think about, that when there's a lot of fear out there, keep in mind that maybe just like it gets the darkest before it becomes light. you know, and that's kind of what we're seeing. We also know that the market tends to come out of a bear market when the economy might be the worst, you know, during a recession, that kind of stuff. So just kind of keep that in mind as some counterintuitive notions. So here's 2000, and this was a very long, you know, 2-3 year protracted bear market. Okay, and so yes, the other concern is either we continue to fall off a cliff or we just come down, you know, bounce and down and bounce and down and bounce. You know, is this another bear market bounce that we're kind of experiencing in January? So I wanted to put this in here. This is the end of, you know, the 2000, you know, so this is around 2003. I've got more I want to talk about this too. But yes, currently the market could retest its October lows. You know, I think that's one of the big questions. Is it going to retest the October lows? And is it going to go even further than that? Like, are we really going to, you know, are we going to really have a big move to the downside like this? The thing I want you to guys be looking at, and this is kind of the informational portion of this whole webinar, is I'm going to show you guys a lot of what we're going to be looking for, you know, signs and signals going forward. I'm going to give you guys some, you know, tools basically. We need to watch breadth. And again, there's more on this later. I'm going to show you what this looks like. Because if in this area, if the market does retest its October lows, we need to keep an eye on breadth and see if participation is also very negative, or the market can move down, but the rest of the tickers out there may not actually go down as much. And that's something to be looking for. And again, I will show you guys what that looks like. All right, but the yield curve, like that is another thing that everybody's talking about. I think we know very well that it is inverted, and that the likelihood of that triggering or preceding a recession is, you know, like 100% basically. We know that. The question really comes into, when is that? We know it's inverted, but when is the recession? And they don't really line up. Just because it's inverted doesn't mean that's when the recession starts. It tends to happen after the yield curve uninverts. So you can see the gray bars. These are recessions, and you can see that the recession didn't actually happen until the yield curve actually got back above zero. So we're very far below zero. Now, maybe this can turn around very quickly, but it hasn't happened yet. And so that's another thing. Everyone keeps wondering, okay, when's the recession? When's the recession? Sure, it can happen, okay? Like, I'm not saying it's not going to, but when? And that might be a thing. And maybe it's going to be off a little bit. And so maybe this could be a little bit of a reprieve that the market could take for a period of time until, say, the recession happens and all that other kind of stuff. So just kind of keep an eye on the yield curve, and just remember, it tends to be after the yield curve uninverts. All right, so again, back to the recession. And a lot of people, you know, it's really concerning. This is like the worst thing that's out there. We're talking about recession. It's bad. But really, let's kind of think about it. The point of a recession, especially right now, is to cut the fat. The businesses and the economy need to go on a diet, and especially after 2020. I mean, 2020 was a gluttonous bubble. I mean, we saw this. So much money was pumped out and printed and put into the economy, like it was insane. Okay, so a lot of companies just grew exponentially, and now they're kind of coming back. They're reverting to the mean. And we're seeing that with a lot of things. There was a lot of hiring because we got pushed into the online business. And what if we kind of, you know, come back from that? All right. We also know that basically the Fed is engineering a recession. Okay, this is what they need to do in order to get inflation under control. And we do kind of need to come back. We might need to have some negative quarters, which we already had two, but we might need to have some negative quarters in order to actually get inflation under control. So we get that. Now, keep in mind that, you know, the Fed is looking for 2 to 3% inflation. We're at 6 something. We could be hanging around at sticky inflation. Now, it may not continue to go up. You know, maybe 18% isn't something we're worried about, but we might kind of hang around at 6-ish%. You know, we'll just keep that in mind. It might be sticky inflation, and that might be something we have to deal with, or the market can kind of handle it for a while until, say, the recession happens and we kind of get things back down. Who knows? All right. There have been dozens of recessions in the past. It's really just part of the economy. Okay, we just need to accept this. The economy will be strong afterward, just like a market correction. Think about this. Again, cut the fat, go on a diet. We need to have things cycle back down in order to burn everything down again, and then, you know, get the new shoots. It's like fertilizer after a forest fire kind of thing. The market and the economy are very similar in that way. We should be okay with a correction. And that is kind of what a recession is. It's a correction, and then we can start again. Okay, we just kind of need to have something like that happen. Earnings. Yes, I know. That is another thing that people keep talking about as far as earnings. Bad, 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 bad. Maybe. But think about this. I was talking to a friend of mine who works at Microsoft. He's kind of higher up. And he saw this before, and he said that they were doing this again in 2022. He said companies are basically taking all of the possible losses they could be taking and threw them into 2022. And the funny thing is, we saw this basically with the stock market. As soon as 2023 rolled over and we hit January 1, didn't the stock market go up? Yeah, and tickers, a lot of tickers nosedived into the end of 2022. That's because of tax loss selling, all that kind of stuff. So businesses are smart, okay? They realized that 2022 was going to be a bad year. We already started seeing it in 2021. And they are going to do everything they can to just like, let's throw everything, including the kitchen sink that's bad, into the 2020 books. And that way we can, start low and have low expectations and keep working our way up. So that might kind of be in there as well. Yes, unfortunately, people will lose jobs, and it will be very bad for some. That is just the price that's going to have to be paid. It's unfortunate, but this is what happens. And the media has been talking about the recession ad nauseum, and maybe a lot of it's already priced in because this seems to be, in my understanding, one of the most talked about recessions ahead of the recession. And it seems like everybody kind of knows this. We got the Fed doing their thing. We know what's happening. It's like everyone is starting to build up their walls and fortify themselves in preparation of the recession. So, hey, maybe when the recession actually does come, maybe it won't be that bad because we've already kind of been preparing for it. It's just kind of an idea I have. It's a thought. Keep it in the back of your mind. All right. Now this slide, I actually took this screenshot February 16th before I took off for vacation. And it is the put call ratio. This was a really good call, as it turns out, because just as I left, that is when the market pulled back. And I told all the Moxie traders about this and what to expect. And lo and behold, that's exactly what happened. You can see here, this is a copy of the alert that I put out there to the subscribers just basically before I left and gave everybody a heads up of this is what we should be expecting. And the put call ratio kind of helped. What you can see is I drew the red lines and green lines to correlate when the put call ratio is high versus low. So go back when this recording comes out, take a look at this, and you can see this is why I was talking to the Moxie traders and saying, hey, we should be prepared for a pullback because the put call ratio is very low, actually. And then keep in mind that the reason why we had such a strong January going into February was the put call ratio was the highest it had ever been all year. That is a lot of kindling for a short squeeze. So, and that's another argument that some people are making, that this run that we had up here, January, February, was really just mechanical. It was really just another bounce in a downtrend because of all of the short squeezes and short covering, all that kind of stuff. Maybe, but we're going to have to keep watching this and seeing where that's going to go from here. All right, so a little bit about me, because I'm sure there's some new eyeballs out there who've never heard of me and don't know whatever and all this kind of stuff, so I'll just take a minute here. But again, my name is T.G. Watkins. I'm Director of Stocks at Simpler Trading. And basically my story is that my dad got me into trading like when I was 3, honestly. I remember him coming home from work and I was sitting on his lap and he'd have me look at stocks and charts and whatever, and kind of do that because he was an investor. And then as I got older, he started taking me around to some seminars like this. This one's actually in Texas. And I was 12 years old and I was basically the youngest person there. I didn't know what I was doing, but I just remember that this was pretty important and that I should kind of pay attention, but it was way over my head. And I remember asking one of the traders, the presenters, I said, is this really possible? Can people actually make money from doing this kind of thing? All these squiggly lines on a screen? And he said, absolutely. And the thing that really set with me is he said, look, none of us were born traders. We all learned how to do this and you could be successful at it. And so what that meant is that if I could learn it, then I can teach it. If I can teach it, I can learn it. And so that was really important to me, especially during some of the tough times. So my dad and I are pilots. Both my grandparents were pilots. You know, it's just kind of around. I grew up in an airplane. And being a pilot has instilled a lot of discipline in me, because if you're reckless or don't follow your checklist, you can kill your account. And this is the Glass Air 3 that we have. That's actually a kit built. We started building that in 1990 and finished it in 1992. You can see the mall back here. That's our trusty one. That one's always doing well. But we had to replace the engine in the Glass Air for the second time, which was a little unfortunate. And now we have about, I think, 10 or 15 hours on that one now. So that was pretty new situation we had to do. And then because 2020 was so good, to us, we decided to upgrade the avionics. So you can see here in the bottom left, this were the original avionics from like the early 1990s. And now we got glass cockpit, as they say. So all touchscreen, really nice kind of stuff. I tell you, there's a learning curve to that. You know, all this new technology, it's nice, but we have to learn a whole lot of new stuff of just to operate this. But basically, I think of myself as a market pilot, and what are we doing here? The whole point of why we're here is to make money and to have success and do better for our lives. And this is some of those examples, being able to upgrade the instrument panel like this. It's my job to absorb the stuff that takes all day to learn. You know, market information, economic reports, notable chart actions, and convey it all back to you guys in shortcut form for subscribers. You know, think of me as your trading coach and mentor. And then just kind of show you guys, like, this is what 2020 was like. It was a fun time. I wish those days would come back, but we'll see. Because again, after a bear market, after a correction, we're going to get some fun stuff. We just have to get through it and start waiting for that to come back. But I was able to grow a $700,000 account to $5.5 million. That's 785% gain using just stocks. Okay, so that was pretty fun. I also did it in another like $1 million account, and I got that up to $8 million. So it's possible, and you know, it's here. So this is the kind of stuff that I'm trying to teach you all. All right, now here are some of the other arguments about like bull market, bear market. This is a screenshot from the SPX 1965 to 1985. And the argument is, you know, we've got inflation and we're increasing rates, but are we chasing? You know, are we chasing inflation? Because the idea that you need to have interest rates over the rate of inflation kind of goes back to Volcker. And so that's what we're trying to figure out. And there is a possibility that we are chasing this, okay? We might have kind of slowed down inflation now, but we might not have killed inflation. These are some of the ideas that are out there. And so there's the possibility that we could be back here where we get actually a few bull and bear markets in rapid succession. You know, call it over the course of a decade or something. I hope we're not in that, but we need to be prepared for that to happen. And so just remember that the bear market that we had in 2022, you know, if we start to be bullish again, and people are like, what are we talking about? How could we possibly be bullish? Just remember that maybe it's good enough for now, and the market's like, okay, let's go. But then something later starts to pop up, and yes, it's a problem later, and then we have to deal with it later. That's kind of like what we saw here. Oh, look, correction? Cool, got that over with. Oh no, more problems? Cool, we got that figured out. Okay, then we go up. Like, oh no, wait, there are more problems? And then we figure that out again, okay? So there's the possibility that we could be chasing this and the market might be reacting to it, okay? So just because if the market might go bullish, doesn't mean we're going to go bullish for the next 10 years. It just means we might be bullish for now and for however long that's going to last. So if the market does, what I want to point out, I like to follow the 10 SMA on the monthly chart. That's this blue line. It does a fairly good job of telling us if the market's bullish or bearish. Is price above or below the monthly 10 SMA? So put that on your own charts and check it out. If the market does crash or roll over, it could be later down the road. That's kind of where I'm getting at with this one, is that if the market, you know, because the market's been sideways for a while, it's basically neutralized. If it does continue to go up and people are thinking doesn't make any sense at all, the next move down could happen later, okay? So just kind of keep that in mind. This might be the first phase, okay? This might be the first round of tightening. We might, who knows? We might need to get up to 8% interest rates. We don't know. But for now, we know the Fed is basically targeting 5.5%. And you know what? It might be good enough for now. It just might be. So we'll just keep your head on a swivel and be open to possibilities. And you know what? Maybe we do get a soft landing this time. I don't know. We'll have to see how this goes. At some point, you think that the Fed is either going to pause or they're going to, you know, pivot, or they're just going to be like, oh crap, yeah, the economy is rolling over and crashing. Yeah, we need to take care of this. So, you know, just remember that they might play chicken. They might blink first, and that could give us a soft landing, and it might kick the can down the road later. But for if this happens and the market wants to go up, okay, fine, and inflation comes back later and, you know, strikes again, fine, we'll deal with that later. Also keep in mind that sideways, so if the market is sideways, that could be a green light for many stocks. As long as the market isn't actively going down, a lot of stocks can take that as an opportunity to move up, okay? You can kind of see that here, the market was not really in a huge bull market rampage thing. You can see it really kind of chopped around through the monthly 10 SMA, but the monthly 10 SMA was going up over the course of time. And that might have been a challenging environment, but you can see it worked its way out of it. So just kind of think, maybe we're there. We don't have to have a rip-roaring bull market, but kind of a neutral to up market might be good enough. Okay, we kind of have to just accept what we have. And yes, I understand the arguments for a bear market or for the economy to crash or for the market to crash. I understand all that. I'm not ignoring those things. I'm just saying we need to be open-minded to some of those things maybe either being priced in or the market just not caring too much, or it maybe matters later. All right, some other things that I thought were interesting. If we look at the monthly Fibonacci's, again, I find this very fascinating. The SPX pulled back exactly to its 50% retracement from the COVID lows to the highs. The NASDAQ pulled back to its 618. The IWM, the RUT, pulled back to its 50%. And the semis pulled back to their 618. Basically all on cue for the pullback. In addition to that, all of them have pulled back to their monthly 50 SMA. Some a little bit better than other, but again, fuzzy lines. So they are all basically pulled back to a reasonable support area, like, a reasonable pullback in an uptrend, 50%, 618% retracement in an uptrend. And they are all on potential long-term monthly support. So we need to just keep that in mind because it could work for now. Okay, we just need to keep that open. Now, if this doesn't work, fine, great. We'll see things deteriorate. We'll see things roll over. We'll see things fall over again. We'll get more news, Russia, Ukraine stuff, like who knows. But for now, it has found support, and we kind of need to keep that in our brains and make sure we're not going to fight that too much. One thing I wanted to then talk about was the semis. For me, this thing has hit every single potential bullish indicator situation that I can work with for now. Okay, like as I said, it hit the 618 Fibonacci retracement. It's over the monthly 10. Remember I showed that earlier with the 1965, 1985. Inverse head and shoulders. You guys see this? There's the inverse head and shoulders on the weekly time frame. And then as far as some specific Moxie stuff, here's a elf shoe. Leg, heel, arch of the foot, ball of the foot. There's the elf toe. So that worked. Trampoline move. So you can see that here on the daily chart. That's a bullish scenario. That's a trampoline move. And trendline break. You can see here we had a down channeling channel. It not only broke over the channel, it came back down and tested the top side of that channel. That's another confirmation, at least for me, that this thing wanted to go up. So again, for now, these things are looking bullish. That might change later. We of course need to watch out for that. But for now, this thing is pretty much hitting everything that I'm looking for in order for it to be bullish. So, I'm going to kind of lean that way for now. This I also found very interesting. The VIX versus the SPX. Now, if we look at, this is back in 2003. It's just an example that I have. And if you look here, the VIX, let's first start here on the left. You see how the VIX had this upward channel rising, kind of like the SOXX had on the way down. Notice currently, this is what the VIX was doing. Notice it was also channeling in an upward direction like this. Okay, so very, very, very similar as the market went down. And then what you'll notice, let me see if I can use a different color, maybe blue. You see here how the VIX actually just kind of broke that channel, came down, and then kind of hovered around $20. There were some spikes and some fits and starts and whatever. But then after that, you see how it just kind of started to channel back down and continue to break down. This looks an awful lot like what we're experiencing right now. And again, what I didn't point out yet is notice that the bottom of 2003 was the peak of the UVXY, the VIX right there, and then it broke the channel and continued down. Look at the similarities here on the right. You can see that where the double green arrow is, that was, for now, the bottom of the market. That was the peak of the VIX. And then what you can see is from there, the VIX collapsed, broke outside of that channel, and is now starting to generally kind of melt its way down lower. Now, if you can see in 2003, it didn't just fall apart. It just kind of chopped around slowly. What we need to do is continue to watch the VIX and see if this is going to continue. If it continues to stay low and break down and whatever, then this looks an awful lot like 2003, about how the VIX behavior was. Okay, that's another thing that kind of is signaling some bullishness to me. And if we look here, again, we talk about the inverted head and shoulders right there. So very, very interesting things that I'm kind of piecing together here. All right, another thing we're looking at is breadth. So the cumulative new high, new low has shown to be great at timing on both the long side and the short side. I mean, look at, oops, let's see. Look at this thing. You can see here when COVID hit, I mean, this thing obviously just cratered. And then it took a while, yes, because the market had already recovered, and it took a while for basically new high, new low, because everything was, through the basement floor, to actually start coming back up. But, as soon as it did, it really didn't look back. And we know 2020 was a special time and all that. But look at the top. Look at the top of the market. And that's when the new high, new low started to roll over, and it really called it pretty well. And you could see, again, it called it the entire time through 2022. That was down. And what we're just starting to see is this thing starting to turn around again. So it doesn't mean that the market has to be rip-roaring to the upside and we're in a raging new bull market. We can be sideways. The market definitely could be sideways for a while, and it can still have some fits and starts. But this is an interesting breadth indicator that is kind of, if you just look at the obviousness of it, is at least saying, maybe a lot of this has already been happened, and we're starting to kind of work our way out. And again, you can kind of see that the market's starting to move up a bit. So yeah. And then I'll dive a little bit deeper in something like this. This is breadth divergences. And so we have the SPX up top. We have the number of stocks over their 50-day SMA, and then we have the number of stocks over their 200-day SMA. And these are all inside of the SPX. And what we can see here is the positive divergences leading into the market decline on larger and smaller scales. And what this told us was that individual stocks stopped going down and actually moved up despite the SPX moving down. This is what I was referring to earlier during that 2000 slide, that if the market goes down, what is breadth doing? And this is the key. Notice here, if you look at the top, you see how the market went lower. Notice how the number of stocks, the breadth, the 50-day breadth, did a double bottom. Didn't want to go lower. There's your positive divergence. And then you can see even lower, like right here, that actually made a new low. Look really what the 50 was doing. More stocks were going up while the market was going down. So that was telling us internally breadth was going against what the market was doing. And you could see that again basically with the 200. And you could also see that the number of stocks over their 200-day SMA was going up. So more stocks were actually starting to recover and go up while the market was still going down. This is the kind of stuff that I'm talking about as far as if the market wants to go back and retest its October lows, let's keep an eye on breadth. Let's see if the rest of the market cares or doesn't care, because this was happening. The other thing to note is that here was the August highs, and you'll notice that this was January, December, January. You'll notice that the market was lower than it was in August. But what did the internals say? The internals were as strong, if not stronger, than they were in August. So even though the market was lower than it was in August, the internals were stronger than they were in August. That is the kind of stuff that you guys need to pay attention to. And that's what we need to, there you go. That's telling us that even though the market went down and was lower, the rest of the market was kind of like, hey, we're done. We're kind of done going down. We're actually trying to recover and start to, build back up again. Okay. That was something. And I was screaming this from the rooftops in the Moxie room about all this. We had a few sessions talking about this and pointing this out. And so that led us into a pretty good January about that. And then near term, you can see near term going into February, the market went higher. What did the 50 SMA breadth look like? And it kind of topped out and started to move down. So again, breadth was telling us that even though the market went higher, fewer and fewer stocks were participating. And this was actually telling us we should be expecting a pullback. And that's why we got a pullback in February. So breadth, it's pretty important. Sounds like ham. It's what's for dinner. All right, the relative strength, we got all that. Okay, so we got that figured out. This is basically, this shows a longer history of what I've demonstrated on the previous slide. This goes back to 2002, and if you could see this is where I was able to find this. The percentage of stocks over their 50 EMA in this case cycle from below 10% to greater than 85% has signaled a bull market pretty much every single time this happened. So basically you get extreme bearish situations, and then you race to the other side, and now you're positive. And that has signaled basically the beginning of a bull market each time. I mean, look at this. And we have just done that same situation. Okay. So, these things are kind of starting to build a little bit of a case. Again, we don't have to have a rip-roaring bull market. It can still take some time to get itself figured out. But, maybe the worst is kind of already in. Now, here's another one, breadth indicators about all this. I feel like if you look at this, it kind of speaks for itself. And what you'll notice is that October, November, December, right in through here, this is the NASDAQ. And yes, it went up, but then it kind of went sideways. And you'll notice the new highs was absolutely exploding. Now it was a very, very low bar to cross. Okay. Like it doesn't mean like we're making raging new highs. It just means that, 52-week new highs, like, oh, okay, finally starting to dig themselves out of a trench. Okay. But this is stark. This is a huge, if you can't see what this says, then, we need to get you some glasses, but this is looking pretty good. Okay. And if you look at the new lows, absolutely dried up. And the thing to really pay attention to is that even though the market pulled back from December to January, look at this, new highs were increasing and still new lows fell off. Okay. This is the kind of thing I'm talking about, that if the market, if the SPY, or the NASDAQ, whatever, if the indexes do trend lower and do maybe test their October lows or whatever they do, if these things actually continue to kind of hold up like this, then that's telling us that there's strength internally and we need to just be aware of it, okay? So that the markets, the indexes can kind of mask what's going on underneath the surface, okay? Just like this. This is kind of what we're seeing. And you can see that the new high, the low ratio here, is now back over zero. We haven't seen this, in earnest for quite some time, and you can see the cumulative is just starting to cross over zero. You can see that here on the SPY too. It's just starting to cross over. The new high is looking pretty good, and basically the same thing. Now, remember when we had the FOMC and we had that big spike up? I think that was early February. It was like a Thursday, Friday, something like that. That was a bit of that was the top. Okay, that was the top of that January run. Is when the Fed came out and said, I think, what was that, the disinflation stuff, or, they're going to rates, or whatever that was. You guys know what I'm talking about. That was, you can see right there clearly that was kind of a blow off top for that time. That signaled the top of that run. All right. How about some history for us? Now, I know this is like a lot to look at, but again, if you guys are watching this on a recording, or heck, you can even take a screenshot right now, you can go back and dive into it. Some simple stuff to look at this. If we look at the top left, a big January after a down year, that's what this is. So here are the years. Here was the January return. We know 2023 was about 6% return, and that was after a down year. And the next year, this is what the stock market did. Now, remember, we are in February. We just turned in March. Okay, we're 2 months in to a new year. We still have 10 more months to go. There can be a lot of oscillation, that I can put it. Whatever path the market takes, like the market could crash tomorrow, and as long as it goes higher by higher than January 1 in 10 months from now, this thing will still be valid. So we do have to be careful about what path the market takes. But this does say that, at least 10 months from now, we're probably going to be higher than where we started the year. I think that seems pretty reasonable. Okay, so we're just not sure of the path, but these things are saying fairly good chance that it's going to, at least sometime throughout the year, end on a high note. Another one here, we look at the top right, bear market prior year. We had our January indicator, and we put that all together, and we have this, because we're looking at the Santa Claus rally is bullish, the first 5 days of January are bullish, and then January was bullish. If you put that all together, you basically here, you have like every single time we've had a positive year. Now, what I really wanted to call attention to was, look at this. Historically, February is a down year, or a down month. It's weak, all that kind of stuff. Seasonality, February is weak. So there you go. It's kind of following the path. So I know a lot of people are out there looking at like what February was. It was a down year or a down month. Fine. Hey, okay, let it be. But I'm not sure. I'm not totally convinced that the market's going to be falling apart right here, right now with that. So that kind of makes March a little bit crucial. We'll have to see how March does. But I'm not going to be. I'm just not super bearish right now on kind of things. even the market's starting to kind of look like it's trying to find some support right now in this pullback. This next one, basically the same kind of thing, just looking at it different ways, a little bit more in depth. But the biggest thing, if you look back, same situation, all times are up given the month end, SPX close, and all this kind of stuff. So you can see it and how that kind of works out for us. All right. Also, what we want to see in a bullish market is we want to see these kind of names leading. We want to see growth. We want to see tech. We want to see consumer discretionary and consumers communication services. That's the kind of stuff we want to see. We don't want to see healthcare, industrials, staples, utilities. These are all defensive names. So this was for January. The correct areas, sectors, were leading for January. So this at least gave us a good opportunity and said, oh, okay, this is what we do want to see. Now again, maybe this changes sometime later, but if we keep looking at this and we keep seeing, the advancers versus the laggards in the right areas, then we're doing well, okay? Again, I don't know if we're going to be kicking the can down the road later with inflation and all that other kind of stuff, so we just need to kind of watch this. It's a living, breathing thing, and the economy does change, so we just need to be aware of that. Also, another kind of thing that might be bullish, the 4-year cycle for presidential, we're right here. So even based on a presidential cycle, we should be more bullish than not. So that's another little interesting thing we could put in. This is another one I like to follow. This was January. It was an absolute blowout month. Absolutely blowout. I mean, it was incredible. And we have not seen something like this for the first time in 19 months. That is a lot of bullishness right there. Of course, it doesn't have to last, but I think it might bode well for some future growth. Okay, so it kind of got January out with a bang. Yes, it was a low bar because things were really kind of imploding going into December, into the end of the year. Again, tax loss selling. So we just had to have a lot of things could just pop from short covering, but it's still something to kind of put a feather in our cap with. And then as far as relative strength, I really like this quote. So again, this is from Monster Stocks, and really especially important that during this time, watch for stocks that don't go down or don't go down much when the market pulls back. This has been the whole thing I'm trying to talk about as far as breadth goes. So look out for relative strength. This is especially important to note if the SPY retests its October lows. Again, everything I keep saying here. But read this quote. I'll read it aloud, but it's fascinating. This goes back to what the 2003 that I was showing. In early 2003, the frustrating back and forth action actually offered a small positive detail. That one key detail was that the selling pressure was drying up even though the general trend of the market was still down. That's the breadth I was talking about. That price and volume action was so constructive during this time that it helped build the final touches of the many bases that would then spring forth when the market really began to turn around in March 2003. From mid-February 2003, even while the market was falling, accumulation and building in the market and healthy bases for many stocks was acting in classic monster stock fashion. Then, when the real movement came, the market acted like a tightened spring ready to take off. That is basically everything I'm trying to explain here, especially with the 50 SMA and the 200-day SMA going against what the actual market was doing, trying to show us that internally things were like, I don't care that the market's going down. I'm already where I need to be. And that's kind of the stuff that we saw in January. Here's another interesting thing. This is the 18 days after the 200-day crosses over, the price gets over the 200-day after a 20% decline. So this is exactly what we're seeing. The market was in a downtrend, and now we have price back over the 200-day SMA. And what we can see is any time that has happened, 12 months later has been positive 100% of the time. So again, we don't know what kind of direction or course we're going to take over the year. We could be sideways. The market could oscillate a lot. We could go down and we could go up. We could do that 5 times in a row. But it just says that the market's going to be higher at the end of the year than where it began at the beginning of the year. So what that kind of tells me is that even if the market goes down, it's going to recover at some point, or the market's going to go sideways, or we're going to have a slight uptick. Okay, so I'm not saying we're going to have this like wildly bullish market or economy or something like that, but it means that maybe the downside isn't as bad as it might possibly be that we're talking about out there. This chart is very, very difficult to read. I've had to look at this and study this a few times. So again, take a screenshot or go find the Twitter poster there with their address. And I'm not going to say too much about this because you really should just kind of go look at it and study it yourself so you can see it yourself. But technically, we did already have 2 quarters of negative GDP. And she was saying that stocks rallied after inflation peaked. Not that it went away, just that it peaked in the mid-70s and early 80s recession, even though the economy and earnings continued to weaken. This is a little bit like that whole breadth conversation that I'm having. It's like people are wondering, how can the stock market go up if the economy is going down? Well, how can the SPY go down if the breadth is actually going higher, right? There are some screwy things out there, and it is possible. All right, and then I wanted to show you guys some ETFs from around the world. I don't remember all of these. I think this is Germany, but go look them up yourself as well. This is the monthly, weekly, and daily timeframes. What I'm looking at is look at this giant move off the lows, and this started in October. Again, I think the SPY, I think it was October 13th. It was a CPI reading. The market dropped and then recovered and ran. Okay, that might have actually been the low of the market. And what I'm looking here is, does this look like we're in a bear market? This is pretty crazy. Sure, expect pullbacks. Look at this in 2020. Huge move up off the floor, and you know what? It had to pull back, find support, and took off again. It could totally do that. I am fully prepared that there could be a big pullback into support, and as long as that support holds, then we can continue to be bullish off of this stuff. So just because I'm looking at this and just because the market might pull back in a big way sometime in the future doesn't mean necessarily that we're going to be all starting over the bear market all over again. So this looks pretty good to me. I don't know what to tell you guys, but that looks pretty good. And if we look at the moving averages, we obviously know what the death cross is, the 50 crossing below the 200. Well, maybe we're coming back from the dead because the 50 is crossing over the 200. EWY, and you can see here, same thing. I mean, does this look like we're in a bear market? I don't think so. And as far as a bear market bounce, well, look at this trend. I mean, look how solid this trend down was, and now we're up over here. So I would just be a little bit prepared or cautious, thinking what's going to happen. Yes, expect pullbacks. Definitely expect pullbacks. They don't go up in a straight line. And this run from October to February was a huge move for, 4 months, something like that. And so yeah, expect some backing and filling. Now we probably need to settle in and actually figure out, is this real, and are we going to hold? But you can also see the inverse head and shoulders, and you can again see the 50 underneath the 200. Now we have the 50 over the 200, and again coming out of COVID, when was it confirmed? Well, when the 50 crossed over the 200. FXI, this is the China ETF. You can see here's where price got over the monthly 10, and here again is where price is getting over the monthly 10. Not always perfect, just kind of a line in the sand, something to be aware of. Because you can also see that price went down, or their bear market started when their price got underneath their monthly 10. And you can see here, here's price underneath the weekly 30. Now it's over the weekly 30. And again, the 50 below the 200. Now we have the 50 above the 200. And again, with the inverse head and shoulders situation. The other thing I wanted to kind of factor in here is that this price peak, the market topped out in February of 2021, which I will argue was basically the beginning of our bear market too, because if you Moxie traders are out there, remember, all of our stops on those crazy wild names that were making us a ton of money and a ton of percentages in 2020 all hit our stops on February 15th, 2021, and they never came back. That was the top of the market. Yes, it had to kind of work its way up the food chain, but that was the top of the market. It was February 15th, 2021. And so since then, it has been 2 years, which for a bear market is a pretty good time. That's pretty average time for a bear market. So you know what, if you're talking time factor, a lot of these things have been in a bear market for basically 2 years or just shy of 2 years. EUFM. Does this look like we're in a bear market anymore? it's kind of hard to argue that. I mean, it's right back up to where it began. So yeah, that doesn't look too bearish to me. It seems a little overbought for now, sure, but it doesn't look too bearish. Just another ETF, Drive. I think it's all the electric cars or something like that. Again, with the 50% retracement and the monthly 50 support and back over the monthly 10. So, again, monthly 10 just kind of is a little bit of a line in the sand. And you could see that there's a double bottom right there. And now we're back over the weekly 50 with the 8 over the 21. And, it just doesn't look too bad right now. It doesn't have to stay that way. Of course, things can roll over. But for now, kind of looking okay. How about Nail? This is the leveraged ETF of the home builders area. What you'll see, monthly 10, monthly 10, monthly 10. Say that's pretty good. And on the way down, monthly 10, monthly 10. Okay, so monthly 10 is a pretty good line in the sand. You can see that there was a double bottom all the way back here. It finished in October. And part of that, you could see that was a trampoline as far as the Moxie indicator stuff goes. So price below the 50, the Moxie indicator above 0, and that's a trampoline move. And then you could see that price started to engage with this, okay? And then let's see, we have some more RETL and XRT. One's leveraged, one not. Just want to show you, look at the monthly 10. Yes, they can go sideways for some time, but they got to start someplace. And you can see it got over the monthly 10. And then when it fell back below the monthly 10, that was the downtrend, and now you're back over the monthly 10. And again, 618 retracement and the monthly 50 SMA. Cool. You can see here on RETL, monthly 10, monthly 10, monthly 10. Of course, as I said, it doesn't mean that they are forever. They can break back down, all that kind of stuff, but at least that is where it has to start. And we're back over the monthly 10. And you can see that basically this thing sure looks to me like it's trying to not go down anymore. So, again, I can't say it enough. Of course, things can change, but if I look at this, I'd be like, wow, that thing looks like it's trying to put in a base and is unlikely to really roll over in like a new way and just keep going down. It's done all of its selling, and now it seems to have found its equilibrium. The Fed's goal was basically to pop the bubble and fix inflation. Well, I think they've definitely popped the bubble. I don't know about inflation, but they've definitely popped the bubble, because doesn't this look like the bubble has been popped? Let's see, other ETFs. Just from this one, this is a social. This is like all the social media funds. Just things I'm kind of showing you guys. The bubble is popped, the froth has been taken out, and you can see like here was the bubble. That was the bubble. That was 2022. And where are we? We're back to where things began. So the bubble's been popped. Yes, things can go sideways. This is what I've been trying to reiterate, is just because we might be coming out of a bear market, or just because things don't go lower, doesn't mean they have to like do a rampaging up move like we saw in 2020, okay? Things can go sideways for a long time. They can chill out, and they can digest. All I'm trying to get across is that perhaps the worst is behind us, because the way that I'm looking at some of these charts, it kind of just looks like, the low is in, and now we just kind of have to figure the rest out and just find the timing of when this stuff is going to start working again. Really, it seems to me that the market is acting more like it's coming out of a correction rather than about to fall off of a cliff. If we are to get another drop, I think it will have to set up later. We're just going to have to keep watching again. Maybe Russia does something, like, who knows? Okay, there's always a black swan possibility out there, and that could change all of this. I mean, we were in a good bull market until COVID hit, and so we really just have to be prepared for anything. Absolutely expect pullbacks. We know this. That is part of a healthy market, are pullbacks. So again, sideways movement, chop, pullbacks, all that. I know these colors are kind of the same, but let me just point out monthly 10, monthly 10, monthly 10, monthly 10, monthly 10. Okay, so a good line in the sand as far as price getting back over moving averages. And then how about this? Monthly 50 support, monthly 50 support, monthly 50 support, monthly 50 support. Very interesting. And this is on the SPX equal weight. All right, bubble pop versus Fibonacci's. XLC was brought all the way back to COVID levels. So, bubble's been popped. It's back to where it began. So maybe we're just going to pretend like 2020 didn't happen, and we can just pick up where we left off. Thing to note, monthly 10, monthly 10, monthly 10. The XLY pulled back to its 618% retracement, and it's basically sitting on its monthly 50. Not super accurate, but there you go. The other thing I will note, I didn't want to draw this on here because I didn't want to make it too convoluted, but if you look at this and you basically draw a channel, if I could do this freehand, look at this channel. Where are we? We're right back into the channel. This is something I found very fascinating, and this might actually apply to our GDP. We already had 2 quarters of negative GDP growth. What if, because COVID and all the money that the Fed printed was such a bubble that we got outside of a linear regression channel, and it was too extreme, and basically we're just trying to get back to trend? XLY looks like it did exactly that. It went straight up, it was excessive, it was a hockey stick, and it came back down, and you know what? It's now right back on path as if 2020 didn't even happen. And if this continues to maintain, if this thing maintains support here, then it's going to just be like it was a bump in the road, and then we continue on. Now, if this is going to roll over and we keep sinking later, fine. That seems to me it'll happen later. We will watch it. We will know if the market's going to collapse again, and we'll just have to be prepared for that. Okay, but very, very interesting looking at this, that it just went outside of its channel and right back in, and looks like 2020 never happened. All right, bases, just a whole bunch of indicator or tickers that some of them were crazy, some of them had IPOs during 2020, but just a lay of the land that winners have to start someplace, and they have to get over their moving averages. The definition of an uptrend is that price is over an uptrending moving average. Okay, so you can see in 2020 or 2022, all of these things were getting smashed, and they were all under their monthly 10. But what has changed now? They're now starting to crop up and get over their monthly 10. This is just a small example of what I'm seeing out there. And you know what? They don't have to be amazing right now. They don't have to be rip-roaring. They could be basing. They could be hibernating. They could stay this way and be dormant for a very long time. But this is how things begin if and when they do eventually begin. So just start building your list, start looking for this, and just be prepared for the names that are done going down and trying to build a base and trying to figure out if they can go higher. Heck, you even have Roblox put in a double bottom, And then here's another group, Sono, back over its monthly 10. Like, you just look at these things and you can clearly see that the bubble's been popped. Snow is putting a longer term double bottom back over its monthly 10. Net, double bottom, back over its monthly 10. Genie, hey, I get it. It's been sideways for a very long time, but whenever these things finally say, hey, we're ready to go again, these names are at least in position to be able to go. Even Space. Now, I don't know if Space is ever going to come back alive again, but it looks to me like it's done going down. That's the only argument I'll make for that. And then meanwhile, and I got to say, this was a little surprising when I kept looking around, that there are a large number of names that are still very, very bullish during this market. There are names that did not go down. They could be, you could argue they went sideways. There are other names that didn't even care. I don't have my dates on here, but there are names that don't even care that 2022 or 2021 happened. Don't even care. And there are names that are thriving in this. So this is kind of, as I told the Moxie traders earlier today, I said, look, I've got some work to do. I've been trying to collect names that actually have been bucking the whole trend of what the market's doing. And these names are making new highs while the market's basically going sideways. And some of these names were doing just fine when the market went down. So what we need to do is look at this as relative strength. Look at Wing. Now, these are monthly charts. They look clean. They look pretty easy. I will tell you, you get down on the daily, hourly chart, like some of these stocks are pretty hard to trade because they're all over the place. But if you look at Wing, what did it do? It pulled back into its monthly 10. This thing looks like it's ready to go on a longer term time frame than anything else. Look at this, monthly 10, monthly 10, monthly 10, monthly 10, monthly 10, okay? And how about this one? And you could see that, yes, some of these names can go sideways for a very long time. You can see this with Deere, went sideways for a very long time, sideways. We need to understand that the market is perfectly capable of going sideways for a very long time too. This is probably the crux of my argument out there, that the market may not fall apart. Now, we may not have a great market. It might still be really difficult, and the rug gets pulled out every so often, and totally possible, and we don't have the wind at our backs. But maybe the market is not going to just implode and crash and fall apart and disaster and all this stuff. Just maybe. And so we need to be prepared that the market could go sideways. Sideways can be challenging, trust me, sideways is challenging. But we look at this is that when we do go sideways for some time, that will build a base. And if the market builds a base and then we finally get to come out of that base, then that's going to be a good market. So there are phases of the market. We already had the bear market, or, I'm not going to say already, but we had a bear market. We were in a bear market. What if we were building a base? And what if somehow eventually we do actually get out of this and come out of a base and we go bullish again? Just be open-minded to it. And you can see here that there are some names like GMAB. What is that thing? Pulling back to the monthly 10? Looks pretty good. How about Schwab? Back to the monthly 10. How about LECL? Monthly 10. Deere, monthly 10. And CELH, monthly 10. Go buy yourself some workout energy drinks and see if we can get that thing higher. So yeah, that's just the big picture of what I'm seeing. All these green arrows are where price basically met the monthly 10 and continued to move up. So good line in the sand as far as bullishness or bearishness. All right, so what do we do about it? Well, I teach you. This was a very educational, informative webinar that I put on for you. I gave you guys a lot of information, and we trade together. I get paid so that all I do is eat, sleep, and breathe and live the market. I love this stuff. This is why I'm here. This is why I love that I was able to get a job doing this stuff, because it really keeps me engaged. If I were doing this on my own, I probably wouldn't be making webinars like this, and I would probably be missing a whole lot of stuff that would actually benefit me. The fact that I do this work benefits me, and that it also benefits you guys. So I absolutely love what I do here, and I'm so glad that I have the work to be able to do it. So I'm happy that I've been able to dedicate myself to this job. I'm also surrounded by other great traders. I read their reports. We do group chats. It's simpler. We do that monthly, group thing, whatever. I'm aware of what everybody else is doing. Now, sometimes we're wrong. Sometimes I disagree with our fellow traders, but that's good to know. And I watch that, I study that, and I see what I can learn from it. And as far as some of the other Moxie traders in there, here are just some quotes to kind of tell you guys like what I do and how people think about it. TQ Trader, I appreciate you out there, but just wanted to say thank you for all the the time that you spend in the room and the consistent great analysis. I'm so glad that I joined your Moxie service and appreciate you. So thank you, TQ. Toro Joe, I know you were kind of a new one into the Moxie specifically, but said thanks for daily commentary. I enjoy reading your analysis. So again, I love that I have this job and that this is what I do. And Law, yeah, love your teaching. Thanks, man. All right, don't trade alone. Again, my job. I collect, I interpret, I distill a wide range of market information for you, and then I present it as a stream of education in the Moxie Indicator Training Room while on the mic and in the post. It's not always just about trading. It's not about just spoon feeding you guys trades and trade alerts. It's about education. It's about making sure that if I leave or I get run over by a bus or I decide to retire on an island or something like that, I've done a good service and I've left you guys smarter than before, more informed and more educated before. If this was simply an alert service, you wouldn't learn anything. I'm going to spoon feed you, and then when I leave, you're going to be like, crap, now what? Okay? The whole point is trying to teach you guys how to fish, and that's what I'm doing here, and hopefully you guys saw that during even this webinar. This is a free webinar, but think about how much I just informed you guys. That is the whole point of what we're doing here, teach you guys how to fish, that whenever I leave, you can handle this on your own. You can teach your kids, your grandkids, and you've gained all this information and insight and basically try to shorten the learning curve of how to trade the market. Sully, I know you're always out there, but new to the class and made a nice profit in Tesla puts. Love your indicator. And then Joe Man, I appreciate you out there. TG, great explanation. Very good examples of how you provide on Tesla. Good job, my man. Thanks, Joe Man. Rob, I agree and happy to be part of this community to share and find that collectivity. TG is a great leader for us. Again, community. We got a lot of people out there. I'm seeing you guys even chatting right now in the free trading room. And, it's great. We got a lot of people who have a lot of posts and comments in there. And then Sus, I have more confidence in your patterns than the market. Well, geez, isn't that the truth right now? Because the market is still fairly tough. All right. So here are some of the bonus things that you guys can value. We have coupon codes. The coupon code is Moxie, so hopefully pretty simple on that one. As part of this, I think if you guys, joining the webinar. You guys, I forget all the exact details, but basically there's going to be a bonus. You guys get the Identify and Actionable Setups micro class. The team will tell you more about that. And just remember, anybody who is new out there and wants to check out the Moxie indicator trading room, Moxie Mastery, we do a $7 trial for 30 days. Come on in, check it out. Just let me know what you guys think about it. And then let me bring you over here to, oh, that was a new question. Let me bring you over here to the Moxie indicator page because I want to show you guys what the dashboard looks like. So this is the area. This is where you guys can come in. You can see here I'm on the mic quite often. I do, anytime I'm on the mic, it is recorded. I also do weekly videos. So there's lots and lots of me on the microphone that you guys can learn from. And if you're new, you can even jump in, do a deep dive. You can like binge watch all this if you want to. Weekly updates, we got that loaded up. All the archives, anytime I'm in a trading room someplace, somehow, it's recorded. You can go back, you can watch all that stuff. The Learning Center, I have pre-recorded stuff, basics, how to set a stop, how to do this, how to do that, trend following, moving averages, like you name it. You can just come in, got a lot of stuff to learn. And then we track every single trade that we take. So you can come in here and you can follow along, you know exactly what trades are in, what we're doing. I tell you when I'm getting in, when I'm getting out, and how I am managing them. And then on the right, these are all the times that we have the Moxie only specific conversation times on the microphone, that kind of stuff. Really good. A lot of, really, I put my heart and soul into this. And if you guys are interested, this is where you come in and find the latest about us. So remember, coupon code Moxie. I'm sure there's more here. And remember, it's a very long name down here. Maybe if you guys can screenshot it, that might help. Or you can just be lazy and call up our team and say, hey, give me that good Moxie stuff. All right, so let's kind of take some questions, see what you guys want. And, and then let's see, since I still got a few times. Aaron, okay, cool. This has been helpful. I'm glad you appreciate it. Just shorted some semis though with hourly Moxie below 0. Well, we can talk about that a little bit. I would just be a little bit careful on the short side right now. We're still a little bit, we've had the pullback. We've had a couple days of pullback, and I'm just not quite sure where things are going to go like over the next few days. So just be a little bit careful out there. Trader Joe, looks like Nasir answered your question about all of the moving averages, so thank you. Yes, the slides are, well, the recording is going to be available. I know we can do that. And if you want, you can just, fast forward each time I go to a different slide, and you can screenshot it. Yeah, Aaron, trust me, it took me a long time to get to the point where stock trading was my day job. And part of that is how I also figured out that my style of trading was end of day swing trading. Because I had a job and I couldn't just sit at my computer all day and babysit it and day trade and all that kind of stuff. So I did have to find a style of trading that worked for me as far as not being tied to my computer. And basically what I'm doing now is that. I can pretty much always predict that the last hour of the day is when I need to make decisions and when I choose to move money. And that has worked out well for me. TQ Trader, you're out there. Nice, man. Yeah, so happy you used my endorsement. Absolutely. I'm glad you guys see that. Hopefully that puts a smile on your face. Cool. Just renewed for another quarter. Hands down the best educator I've encountered in 3+ years. Awesome. Really do appreciate that. LT, is there a free breadth indicator we should add to help analyze the overall market in the way you did? Well, yes, there are a variety out there that you can just kind of find. You can go to stockcharts.com or even just some websites. And I would really say I like number of stocks over their 200-day SMA, which is what you saw in the presentation. And then for a little bit more nimble, you can also do number of stocks over their 50-day SMA. And that should give you kind of an idea of what's going on out there. Because, again, hindsight is 20/20. But we saw, I think it was in 2021, that even though the market, even though the indexes and like Apple and Tesla and all that were still going up, you could clearly see. In fact, let me, since we're into the question portion, let me get this for you, because this is pretty amazing. Let me get over here, and you could use this. So this is the 200-day. So right here, you could see right here that the number of stocks over their 200-day SMA was falling off a cliff, even though the market was still going up. During this time, the S&P was still moving up. But what you could figure out was that underneath the surface, more and more stocks were failing and going down and, just in a downtrend. And so, yes, breadth is, I find, to be very important. It's what we're seeing out there. And that was the other thing that helped clue me in that we were probably putting in a bottom in through here. I mean, here you go. I didn't quite show, well, I did show this in the presentation, but I wasn't highlighting it. Notice that we got a double bottom, So I think that was clearly important to see. And then that is what sent us off of, basically October. That was the October lows, or leading up into the October lows. So yeah, I think breadth is pretty important. So, Mark, as far as the Dow, yes, I know that this is, the Moxie indicator's down. It did a pretty good job signaling that. You could also see that here on the hourly chart. The Moxie indicator just, nothing was of interest, and you could see that there was some negative divergence in through here. So this pullback wasn't too much of a surprise. And if we actually look at the monthly and weekly time frame, there was a gap here, right there, between price and the 50. And I think going into February, there was a gap here through the monthly 10. So I was not surprised to see this pullback. I kind of figured that the rest of the market was going to pull back too. I'm not so sure that I want to say that price is really going to crash and implode. Right now, I would still really make the argument that this is basically sideways for 4 months. Okay, this has still just been sideways. It's in a range. And since the Moxie indicator is a momentum-based indicator, when there is no momentum, the Moxie indicator goes down. And that's what's happening. Like, you can kind of see that even here on the hourly chart back when this was happening. It was mostly just sideways, and you could see the Moxie indicator just rolled off. So there's really, honestly, I really don't have much to say about the Dow, because it's just not doing much. It's just not doing much. It's sideways. Kind of tried to crawl up and then pull back, and we're going to have to kind of see what the next something is. I would be very cautious about trying to short it here, though. I think we've had several days of down moves, and we are starting to come into areas that I would view as support. So I'd be very cautious on the short side right here. That doesn't mean we have to go up and go long and have a great up trade, but I'd be cautious on the short side. Oh yeah, sorry guys, you probably need that ticker. Let me put it into the chat. So there you go. That's what the ticker is for breadth on the SPY. It's basically $ SPX A 200, for 200-day, and then R. And you can take that same one, and if you just change the 200 and you turn it to 50, that's one of them. And if you turn the 50 or the 200 into 100, that's another one. Yes. Okay. So about the power dots, let's come over. Let's see. We want this one here, and let's just talk about which one was a good one. I'm trying to think. We had. Let's see. Let's just use the SOXX. Gosh. Well, no. It was GDX. That was the one we were talking about today. Bingo. There you go. Okay. So the power dots. I had a few subscribers asking me about more stuff about the 15-minute time frame. They're like, hey, can we scan for it? Can you do something about when the Moxie indicators are close together? Like, how can you give us more signals or any signals using the 15-minute time frame? And Eric and I had to put on our thinking caps, and we kind of said, okay, well, what do I teach? How do I teach the Moxie indicator? And the thing that I was always teaching about the Moxie indicator on the 15-minute time frame was about that in order for a good move to happen, you need the two Moxie indicators to come close together to each other. They need to act like one line. And so Eric's like, cool, well, I can write a program that basically says when the Moxie indicators are within a certain percent of each other, I will put a dot, or something. And so that's what we did. And obviously you can see that it fires a lot. So, I'm not saying that every signal, don't take every signal. All it is a visual representation to help call your eye to a situation that might be pretty good. And you can see here with GDX that this one was right on time. You can see that price started to engage with the 15-minute 50. The Moxie indicator, look at this, started to break out into new high territory, and the Moxie power dots started to fire, indicating that they were close together, indicating that they agreed with each other and that they were strong. This worked very nicely. Okay, that's kind of the point, to show you that when they get close to each other, there tends to be some energy behind it, whether it's up or down. It just depends on which way the indicator's going, and that's what you do. These are only on the 15-minute time frame, because only the 15-minute time frame has 2 Moxie indicators. Okay, so that's something that we did there. The other update that we did was we added Moxie price triggers to the 5-minute and the 2-minute. You can turn these on or off. Same thing with the power dots. You can turn them on and off, and you can adjust 10%, 5%, 2%, like whatever you want on those power dots. So let me just say, all the price triggers are doing is they're just telling you when the Moxie indicator is crossing above or below 0. Like that was a trampoline move, and then we were getting these triggers. Now they are on the 5-minute and the 2-minute. They move around a lot. There will be a lot of arrows, and I make no guarantee that you just trade it by the arrows. That is not the principle of the Moxie indicator. You need to read the indicator. But I'm just trying to, people asked for it, so I said, okay, we can do this. And you just need, it's just an extra visual cue, but you still need to trade based on everything you see with the Moxie indicator, moving averages, and the overall trend, okay? So don't let them confuse you, and don't just, go in with a blindfold on and say, okay, the Moxie price trigger is telling me what to do, okay? So that's pretty much it about the power dots and then the price triggers. Albert, nice. Might have to grab this one too. So Albert, the Moxie way has helped me navigate the markets and become more profitable. Love the simplicity versus having a lot of indicators. Thank you all for you do. Sure. Yeah, that was another thing that I figured out is long ago, I needed to keep my trading page clean. I did learn, well, there was one older trader, he's passed away now, but he had so much stuff on all of his charts. I swear I could not see price. I don't know how he made money, but he was wealthy as could be, and I could not see price through everything he had on his charts. I don't know how he did it. And I just kind of knew, like, okay, that's not going to be me. I need to make sure that I keep it simple. This is also part of why I have my price bars grayed out, is because I really just want to see the cleanliness. I want to see the moving averages, and I just want to see price and how well it follows or does not follow moving averages. The red and the green throws me off. You get greedy, you get fearful. I don't want to do that. I don't want that psychological thing to be working on me. And by the time you add all these colors, I can't see the moving averages. It's very important to see the moving averages. I mean, look at this downturn in GDX. You'll notice that the 8 stayed below the 21 the entire time. What changed? 8 crossed over the 21. And you know how well I can see that? Because the price bars are kind of grayed out behind. I can see that very well. And that's why I do what I do and keep it simple. Mott, so I don't think we can do scanning for TradingView. I know we're limited. TradingView still has some limitations. I don't think we can scan for that. Even stock charts were limited. They are still working on scanning features in general. So unfortunately, if you want all of the bell and whistles, Thinkorswim is the place. And I know maybe that doesn't work for you if you're outside of the country or there are certain restrictions, so I really apologize about that. But we are trying to grow these things on all the other platforms, but sometimes we're really just at the mercy of what the platform is. Also, funny enough, the Moxie indicator is kind of so unique that it's so unique that it just doesn't work on certain platforms. Like TradeStation, it will never work on TradeStation because of the way that TradeStation is built. Trust me, we've tried. So that's kind of the gift and the problems of the secret sauce behind Moxie, that it doesn't work on certain things. Aaron, gosh, you know what? I would love to have Moxie on Thinkorswim Mobile. I do not know why it doesn't work. We've been doing that ever since since I built it. I remember my dad bought me an iPad way back when. He's like, "Here you go. Now you can trade while you're on the road." And then that's when I found out that I could not put the Moxie indicator on mobile. And so then we returned the iPad because I just didn't need it. So no, I don't know why. I don't know what the deal is. Again, limited by Thinkorswim. That is their situation. I don't know why. But if you have a laptop, it'll work on a laptop. So, do that. Let's see what you can do. Maybe like a laptop tablet. I don't know. Microsoft. Maybe they do something like that to where you can get it the size of a tablet, but it's more like PC based. Cool. All right, guys. Well, looks like that's pretty much all the questions. Be sure to watch the replay if you guys want to. I always actually watch myself. I think that is one way to really learn. That's how I actually started. Was I was making videos, and then I would just learn on my own. I'd actually watch my own stuff. And then I think that's you kind of continue that feedback loop. You speak, you hear yourself speak, you see it, you just circular. Every single way you can learn, just keep doing it. And for me, making videos and then watching my own videos really is where it was at. So keep it up, guys. And for the rest of the Moxie traders, we'll see you in the room tomorrow. Thanks again. Take care.